Hey, what's next with money? Do you ever think about wanting to know what the future would hold? That you could time travel to pick stocks that really worked? Here in this valley in Yosemite National Park, where time seems timeless, there are a couple ideas to make your portfolio work for you with the future in mind without really knowing what's in store. Welcome back. Coming up on today's program, how to invest in what you know to create wealth and grow your investment portfolio. You might say, what do I know that is that special about investing? I'm not an investing expert like the Wall Street big boys and girls. So how do I and how should I invest in what I know? And the bottom line, folks, is opportunities and knowledge about companies surround us. At What's Next with Money, we talk about personal finance, but often with a connection to the goal of ownership. And through owning assets, we receive many things: independence and choice, good works for others and society, as well as creative and fulfilling enterprise that we can do for ourselves and our family. Welcome to What's Next with Money, a program with smart insights to guide your financial decisions. Let's get started. Peter Lynch, the former portfolio manager of Fidelity's famous Magellan Fund, wrote several books. This is by far his most famous. One Up on Wall Street. He declares that we, in our regular life at work and at home, have advantages in and for investing beyond the Wall Street crowd of investment professionals. I will explain this concept of invest in what you know, how you can use it, even practice it, and show you some of my successes and failures with it. Plus, I will give you Peter Lynch's and some of my 10 investment principles. So, our unique points of view and our situational awareness is the key. Whether you're an experienced investor or not, in your life, you see many things clearer and even have a better knowledge of and gut feel for than other investment professionals. Going one up on Wall Street, as Lynch calls it, you have a unique perspective as an employee, employer, gig worker, student, or business owner. And then in the consumer world, you have a unique perspective as a consumer. And you know what your family's consuming. You monitor and have a sense of their habits and interests. You also have a unique perspective as a community member in your social, civic, faith-based, and education life. You see, hear, read about, and experience directly or through colleagues about companies you understand, in industries you appreciate, and here's the big one: you have a natural or gifted interest in. So it's really not even hard to focus on those things around you. The question of the day is, what is your advice or experience? What are you experiencing with investing in something you know or in your own region or backyard? Throw in a few examples or questions in the comments section below and let us know what you think. So how do you invest in what you know? Well, you can write down your investment observations in a journal or on your computer or in a phone file about the businesses that are doing well and that you know and you understand, and those that pique your interest. And remember, behind every stock is a company, and behind every industry or field that you may know about is likely an investable sector. Now, through individual stocks, securities, and equities, or sector-focused ETFs or mutual funds, and ETFs are exchange-traded funds, and many of these have indexes, but you have an edge. I like to draw circles around my zones of competence, or even journal ideas of what interests me, what I've been trained in, what are my experiences in the companies that kind of match that. And here's a wild one: in often a field or industry or sector I would want to break into so I can have fun and be a little aspirational. Now for me, my sectors of interest have been and are media and entertainment, financial and investment services, real estate, defense and national security, aviation and aerospace and international. And then there are I would say collectively our consumption patterns. And all of us consume what I'm about to state: food, education, transportation, housing, energy, utilities, technology, communications, media and entertainment, health and medical, travel and recreation. So that's kind of my list in those generic categories. But there's another big generic category the investment community has set up, and you've probably heard about this, the S&P 500 of really top performing companies. And what they've done is they've divided this area of the S&P into 11 sectors based on size. And here they are as follows: information technology, healthcare, financials, consumer discretionary, communication services, industrials, consumer staples, and that's like Procter & Gamble, Kroger, companies like that, things you need all the time, energy, utilities, real estate, and materials. Now, these 11 categories can help jog your thinking, and there are so many subcategories of sector specialization under each, and most of which are investable. And I'm going to break one down just as a quick example. Let's take the category of real estate, which is actually put out as one of the 11 sectors as the S&P reconstituted those sectors. So this is now broken out. So what do you do with real estate? What can you invest in, what you know, or area of specialization? Now you can do single family home rentals, hotels, data centers, student housing, medical facilities, apartments, condos, resort properties, vacation properties, office buildings, warehouses, self-storage, land, home builders, building suppliers like Home Depot or Lowe's. And all these have companies behind them. So you can see how these big categories sink down, niche down to these smaller categories and provide avenues of sector and more precise investing in an area you're passionate about. But it's not just your interests. It could be your parents' professions or their experience, your grandparents, your spouse, and watch what your kids and friends are buying or thinking about and talking about. Now, a big one to me is right under your feet, and that's your locality. What are the plants, the headquarters, the regional offices, or even a test market in your area? This is where news about companies and opportunities gradually, on a weekly basis, just flow to you. You learn about some of these companies in your locale early before they do on Wall Street, but you're going to learn about them in a more active, precise manner. So in a few moments, I'm going to show you 10 tips on how you can use your knowledge and even practice and show you some of my successes and failures. Now, we're talking about how to invest in what you know to create wealth and grow your investment portfolio. And don't forget to hit that subscribe and the like button to help move this content to more people, and you'll get a free reminder when we post on Thursdays. Now, here are 10 investment principles to think about, and many of these come from Peter Lynch and his book, One Up on Wall Street. Number 1, mediocrity is your safest play. This is the idea of boring is good. And for me, kind of a mundane area that I've invested in as a subsector specialty for years is water and water utilities. Number 2, experts have built-in disadvantages that you and I don't. The experts have to try to attract and serve financial customers, and these customers want to throw money at the investment professionals, and they often do that and get very excited when the market is high. And those businesses and the stocks that represent the businesses are expensive. But in turn, many of those investors move out of the markets in a panic after prices have dropped, and they often lock in their losses. Just at the time, it would be more valuable to buy more shares or to hold if the investment thesis is right and they've done their research. So this is the concept of most people do the wrong thing at the wrong time. But you know what? Americans and investors and new investors are getting much smarter. Many are learning not to overreact and to actually act wisely for their individual circumstances. And sometimes doing nothing in a market downturn is the right thing to do, the right play, because they have a long-term investment horizon. And through those down periods, they often keep slowly investing and seeding money into investments that meet with their long-term objectives, and they do it at lower prices. Number 3, you have a unique point of view and perspective. Now, we all have an edge to make money. Years ago, when I did buy newer cars, I liked Subarus because I like four-wheel drive and the outdoors. And it turns out there was an investment in what you know opportunity right in front of me. I never took advantage of it, but I learned later that there was a shortage of Subarus, and Subarus were breaking out into the United States and became kind of the dominant small car in a few states because of the advent of the all-wheel or four-wheel drive. If I had realized what was happening and why it was hard to order a Subaru because of the shortage, it was a high demand. And that turned out to be later reflected in the stock price. So instead of spending money to buy a Subaru, if I had taken that same amount of money and bought stock in the Subaru company, that stock would have bought me many Subarus. Number 4, you're not rushed or pressured to take unthinking, fast, or panicked action. And when I rush, I often make a mistake. And this is, we all know what that's called, FOMO, fear of missing out. So I was not an active investor in software and the computer sector, but I did later have a second chance. Although I bought some of those products, and that's where I was voting with my dollars, there was a company that I did start to patronize that I kind of liked. It was called CompUSA, and this was like a Best Buy for computers and software. And they were very helpful, and they became public, and early on I did buy shares in that company and did quite well. So I missed maybe the first run-up or the early run-ups in that sector, but I had a retail play, a consumer discretionary play with that company later, and I was able to profit from that. Number 5, if you like the store, as I did in the prior example, product or service, chances are you're going to love the stock or sector. Now, I have here a bag about Chipotle. The first Chipotle restaurant is about 6 miles from where I'm making this video. And in the Denver area, I saw a lot of local press about Chipotle and was impressed with what was going on. Now, the stock couldn't be traded publicly, but I was actively following how the business was evolving. And a big event happened before it became public. McDonald's, yes, McDonald's, the Golden Arches, bought a big piece of that company. And when later the company went public, McDonald's sold out, took big profits, but they injected a lot of capital to help Chipotle actually grow, and both companies profited from that move. Now, this is the only time I've ever bought stock on the first day of trading, what is known as a initial public offering, IPO. This is when I phoned in to the discount broker that I used my limit order for X number of shares. I was actually in a medical facility, and so I was sort of under doctor's care during this time at the first day of trading. And they said, oh, you can watch TV if you want for a while. And I said, put on CNBC. And I found out they only mentioned Chipotle like 2 or 3 times. I was waiting for them to give pricing and kind of what was happening. And that network really underplayed the first day of trading of that company. It kind of gave me a little confidence that I probably got in early on a company I had followed and watched in its early development. And years later, I sold that stock for multiples of what I had invested in. And if I had kept it longer, it would have been even greater. But I had to pay off a big debt from a real estate situation that was a little problematic. You'll hear more about that later. Number 6, your dollar votes count. So look at your credit, debit, and checking account statements. See where you spend and where your family is spending money. Also think about your income sources. Often this is a record of favorites. And in my case, I was a very active investor, and I realized I have some favorites in the financial services and investment management space. Even though I was primarily in financial education, these were allied fields, and those companies were investable. 7, remember, say you like a product or service. This alone may not be an indicator of a good stock because the product that you like only represents a small part of the company's earnings. As Peter Lynch says, one product may not move the needle for the stock, but it could be reflective of broader quality, innovation, and future performance. You see in my videos, I use a lot of Disney paraphernalia. I've probably got 25 to 30 books about the Walt Disney Company. I worked there for a very short time to help them with the Epcot project. Notice this little commemorative piece. And I feel like I've lived the company. I've been invested in that stock since probably my teen years and have added positions through dividend reinvestment programs and just followed the company. So I know about their pioneering innovation, creativity, people management. I use many of their business techniques. I kind of like it all. So this is the case where I am personally not that worried about one part of the company underperforming because I know how all the other pieces work and they work together, and some of it is seasonal. Some of the times parts of the business are down, and certainly they've gone through all kinds of changes because of the pandemic. Number 8, you need to see if the company is healthy and in good shape. You can see the ratings from brokerage firms, and of course this is really beyond the scope of this video, but Peter's book lists a lot of techniques to how to evaluate a company's health and whether it's worth investing in. Number 9, core and explore. Now we talk about this at What's Next with Money. And core meaning the larger positions you hold in your investment portfolio in retirement funds and even outside can include index funds, mutual funds, exchange traded funds, or some individual stocks. But what we're talking about here is a little riskier. This is more niched and nuanced. Investing in what you know would be the explore category, not your core positions. This is sort of the spice and the garnishes around your investment portfolio. Over time, if you hit it right, these may grow significantly, and then you have to think about asset allocation to stay diversified. Number 10, and this is a fun one. Can you explain a stock or an investment purchase that you own to your child? And I bet if you invest in what you know, you can do that. You're going to have this innate sense of what's working in that company or that sector or field. Now, you say invest in what you understand. And years ago, I explored a career change and did several interviews and a lot of research into a sector of businesses that were very prominent in the Colorado, Denver area. And this is the cable business. And so as I interviewed with companies, got to know them, meet some of their professionals, I'm still friends with several of them, and go through job interviewing, I ended up reviewing those companies. I didn't end up going into that field professionally, but I did invest in a few of those companies and because of my deep understanding. So there's a case that didn't come from work. It came from sort of a career exploration opportunity, and it came out to be a cool investment thesis for me. So you can invest in what you know. You have a unique perspective at work. You have a unique perspective as a consumer. And we have a companion video on this topic so we can go into a deeper dive. And be sure to hit that subscribe and like button, and don't forget to share this video and other episodes of What's Next with Money because, hey, they're posted on Thursdays. Thanks for watching.